Now our topic is fire insurance. It is impossible to predict a fire and how destructive it can be. However, we can prepare for it by purchasing a fire insurance policy. Fire insurance policy is a policy which covers the loss or damage to the insured property due to fire and its allied perils up to the amount specified in the policy. There should be actual ignition. If the insured property is damaged by own fermentation, natural heating, spontaneous combustion, it will not be covered under the word fire. That is, in that case, the claim will not be paid by the insurance company. Normally, the fire insurance policy is for a period of 1 year, after which it is to be renewed from time to time. There are two conditions for getting the fire claim. There must be actual loss and fire must be accidental and non-intentional. If overheating without ignition causes damage, it will not be regarded as a fire loss within the meaning of fire insurance, and the loss will not be recoverable from the insurer. Then these are the 7 principles of fire insurance, and we will discuss each of these principles one by one. First is principle of insurable interest. We have already discussed this principle in detail in our previous course. In the case of fire insurance, the insured must have insurable interest in the subject matter of insurance. Insurable interest must be present both at the time of insurance and at the time of loss. If the property is sold to another party, the insurance contract will be null and void. Here we have given a few examples of insurable interest. First is, a person has insurable interest in the property he owns. A businessman has insurable interest in his building, stock, plant and machinery. A partner has insurable interest in the property of a partnership firm, and a mortgagee has insurable interest in the property which is mortgaged. Second principle is principle of utmost good faith. Fire insurance contract is a contract of ubrime fide, that is a contract based on utmost good faith. It means standard of honesty required in insurance contract is greater than that is actually required in most ordinary commercial contracts. According to the principle, the insured must disclose all the material facts regarding the subject matter of insurance to the insurance company truthfully. On the other hand, the insurer must provide to the insured complete, correct, and clear information regarding the terms and conditions of the contract. Now, third principle is principle of indemnity. The contract of fire insurance is a contract of strict indemnity. In the event of loss, the insurer will pay the insured the actual amount of loss or sum insured, whichever is lower. For example, a person gets his stock insured for rupees 5 lakhs. There is a fire in the shop. The insurance surveyor assesses the loss to the tune of rupees 1 lakh. In such case, the insurance company pays rupees 1 lakh and not rupees 5 lakh, because the insured cannot be expected to make a profit out of the loss. Further, the purpose of insurance is to place the insured in the same financial position which he occupied before the occurrence of the loss. Now, the next principle is principle of proximate cause. In the case of fire insurance, there are certain perils specifically mentioned as insured perils, whilst some perils are excluded and some perils may be covered under the insurance policy on payment of extra premium, and some perils may not be covered at all. The insurer is liable to compensate only when fire or other covered peril is the proximate cause of damage or loss. Let us understand this concept with an example. There was a fire in a factory. Firemen were able to remove the undamaged stock from the burning building and protect it from fire. Thereafter, rainwater damaged the goods because the goods were placed in the open yard. Here, the proximate cause of damage is fire or rain. If the rain damaged the goods before the insured had an opportunity to protect that goods, then the proximate cause of loss is fire and covered under the fire insurance policy. But if the stock was left uncovered in the open for a long time, then rain would be considered as a new and independent cause of damage. Now, next principle is principle of contribution. The principle of contribution applies to fire insurance. According to the principle of contribution, if you have taken insurance from more than one insurer on the same property, then all the insurers will contribute the amount of loss in proportion of their respective coverage. If the full loss is paid by one insurer, then the insurer who has paid the claim has the right to call upon other liable insurers to pay their share of loss. Here we understand this concept with the help of an example. A person got his factory insured against fire loss for rupees 5 lakhs with insurer A and for rupees 10 lakhs with insurer B. There was a fire and the loss was to the tune of rupees 3 lakhs. Then insurers will contribute the loss in the ratio of 5:10 or 1:2 and will be liable to pay rupees 1 lakh and 2 lakh respectively to the insured person. Next principle is principle of subrogation. This principle comes into play when a loss has occurred due to some other person or party and not the insured. According to the principle of subrogation, after settlement of the claim, the insurer shall be entitled to take over all the legal rights of the insured against the liable third party for recovery. Now, the next principle is principle of loss minimization. As the name suggests, this principle states that it is the duty of the insured to take all reasonable steps to minimize the loss to the insured property on the happening of uncertain event. Suppose goods kept in a storehouse catch fire. Then the owner of the goods should try to recover the goods and save them from fire to minimize the loss or damage. The insured must behave with great prudence and should act as if he is uninsured. The owner should have called the nearest fire department office and using emergency fire extinguishers, etc. Now we will discuss some the main elements of a fire insurance contract, which are as under. First is presence of insurable interest in the subject matter of insurance, both at the time of insurance and at the time of loss. Second, the contract of fire insurance is a contract of utmost good faith. Third is fire insurance contract is a contract of strict indemnity. Fourth is insurer is liable to compensate only when fire or other covered peril is the proximate cause of loss or damage. We may also add that we have already uploaded many courses like email writing, present tense, future tense, past tense, cyber security, letter writing, most common mistakes, forms of business organizations, DBMS, information technology, web applications, and much more. You can look out for the same on Google, YouTube, our own website, Udemy, tutorial points, etc. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.